Hi, everyone, and welcome to your next session here at RETCON Multifamily. We're talking about growing profits with the Flex multifamily model and management agreements. Our speakers today are Shaun Fink, Vice President of Asset Management at ZOM Living, and Will Lucas, Founder and CEO of MintHouse. Shaun, Will, welcome.
Thanks for having us.
Of course. So I know our audience would love to learn a little bit more about the two of you. Why don't we start there?
Yes, absolutely. So appreciate you having us on here, and I'm excited to have this conversation. I think this will be the first, if not, one of the first honest and detailed conversations between a professional short-term rental operator in MintHouse and a landlord partner under the context of a management agreement that we have signed at a property in Miami, and we're going to actually go into actual operating data and performance data so that everyone can see how it looks and how it all works, and what the NOI splits and how much additional NOI that we're able to create under our operation relative to traditional multifamily use. And so first, I'll just give a quick background on MintHouse. So MintHouse, we are a tech-enabled or next-generation hotel company that has two fundamental differences as you compare us to the Marriotts of the world. The first of which is that we operate out of luxury multifamily buildings, apartment buildings, in lieu of the traditional hotel-style building. We currently operate in 13 markets around the country and over 25 buildings, and growing rapidly with plans to be in over 20 cities by the end of this year. The second thing that's totally different about us at MintHouse is that we power the whole experience via technologies. That means digital check-in, digital checkout, digital concierge, customized fridge stocking. So you can pick out what you want via SMS link or on the app, and it's waiting in the fridge upon arrival. You can order branded MintHouse room service that we power through ghost kitchens. You can order massages on demand, and much more. And so as you put these two points of differentiation together, we do think we're in the process of changing the hotel industry forever. And my evidence for such a bold claim is in some of the rankings of our properties. And so we have top ranked hotels in many of the markets that we operate in across the country. In many cases, the best ranked hotel in that particular market. And in fact, the team is very thrilled that just recently, a few weeks ago, TripAdvisor named our property in New York at 70 Pine, where we have 132 units in a 500-unit multifamily building, the top ranked, the best ranked hotel in the entire country. So this is based on guest reviews. And so I think the team is really excited because, it's quite an accomplishment for a company that has less than 4 years of operating history to, be out competing some of the most iconic brands in the world. And we think this is a really powerful demonstration of the model itself. And I think MintHouse's ability to operate and be a leader in this space. So with that, I think I can pass it over to you, Shaun.
Yeah, thanks, Will. Thank you, James. Glad to be part of the conference and conversation here. So just quickly on ZOM. So we're a multifamily developer founded in 1977 in Orlando, Florida. Have developed over 22,000 units nationwide at over $4.5 billion in value. Currently have offices here in Orlando, Fort Lauderdale, Texas, North Carolina, Washington, D.C., and just recently opened one in Phoenix as well. This particular project, the Muse at Met building, so it is the final development in the Metropolitan Miami redevelopment, which is a 4-city block master plan redevelopment right in the heart of downtown Miami and CBD. The master development includes 800,000 square feet of office, a JW Marriott Marquis Hotel, Whole Foods Market, 30,000 square feet of restaurant and retail space, and a 1,200 space parking garage. The Met Square project itself, the final piece here is a 43-story tower that includes the Muse at Met Apartments. That's 391 units. and 2 stories of 30,000 square feet of retail, and along that, with that, a 18-screen Silver Spot cinema. And then just one other note on the project itself here, it had received multiple industry awards, most notably the NAHB's 2019 Grand Aurora Award for Best Mixed Use Project. So we're very proud of the deal and the project and how it turned out. On the amenities, just briefly, so it's fully amenitized with the resort pool, wellness center, treatment rooms, sauna, steam rooms, full fitness center, dog salon, dog runs, a convenience store, and a full service 24-hour valet. And I mentioned before the project is 391 units, of which MintHouse operates 2 full floors, or 22 total units.
Awesome. So I'm super excited to dive into this discussion today. Short-term housing is something we've been seeing for a while now, and especially recently have been seeing so much innovation. And to talk about this innovation, I know MintHouse has this really, really, really fascinating flex multifamily model. Will and Shaun, I'd love to learn more about that.
Yeah, certainly. So maybe I can start by just defining the term flex multifamily. So flex multifamily is the asset class that we are in the process of creating here at MintHouse. So from the real estate perspective, so flex multifamily is essentially just any multifamily building that has some percentage of that building being operated by a short-term rental operator like MintHouse. So another way of thinking about it is the easiest way for you to make your building mixed use is by making it flex multi and bringing in MintHouse. You can do so without any sort of pre-planning, pre-development expense. We pop in and immediately begin generating a higher NOI. And the second we move out, it immediately doubles as its original use, which was traditional multifamily. And so today, 80% of new developments are in fact mixed use. That wasn't the case 20 years ago. Developers have learned that there are all kinds of benefits to having a mixed use building, from diversifying your revenue stream to creating a little bit of a network effect within that building. And so on the flex part, there are a couple different elements of the flex that make up this definition. And the first is what I already mentioned, which is the ability to flex in between uses, between those mixed use, short-term rental back to traditional multifamily. It's the flexibility and the duration of leases that we can, and reservations, that we can bring into our units. And so during different economic periods or down seasonal times, we can bring in longer stay guests. And so during the pandemic, as an example, we were bringing in primarily longer term stay guests with an average nightly stay of over 20 nights, many reservations, 30 and 60 nights. And we can do that during a down seasonal period, like a January or February in New York City, as an example. And then the last piece is flexibility in the percent of the building that we operate. So we're comfortable operating 10% or less in the case of Music Met, 50%, and also the entire building. We have a number of buildings where we actually manage the entire building. So it just depends on kind of the wishes and business plan of our real estate partners.
Yeah, and I would just add to that from our end. I mean, you covered most of it, but the value in that flexibility is pretty paramount here. In that, this is a somewhat proven space, but obviously still a lot of nerves and questions from operators like ourselves or our capital partners. And so having the flexibility to come into a deal like this and have the mixed use, but then can vary in size, in guest, as Will said. It's really helps kind of spur adoption and bring more investors and projects to the table, I think, certainly on our side. And then, for us in the future with these, I mean, this is just, as Will said, it's another amenity for the building. It's another revenue stream for a lot of buildings. So it's something to be thought of, and with just some minor kind of early life cycle pre-development programming changes, can really be a big value add.
And a really important piece of this is any owner brings on a significant partner or operator of an asset or portfolio is that partnership and agreement. And I know MintHouse operates on a really, really unique management agreement. Will, I'd love to learn more about that.
Yes, certainly. So I think our space is in the process of, I think eventually almost all or all at some point of the agreement signed between short-term rental operators and real estate partners will be management agreements. This is the agreement we've been signing for the last year and a half. We originally did sign leases, but made this shift to management agreements as the model was proved out back in 2019. And I think the events of last year really helped accelerate the transition to management agreements as there was a sort of collective recollection across the market that these leases that folks were signing weren't nearly as secure as we thought. And we think the management agreement is the model of the future and the right model because it is better for both parties, frankly. So it aligns interests between us and our partners, and most importantly, it allows for our owners to participate in the upside that we create. And we can generally create 2x or in some cases more than 2x the NOI that you can earn under a traditional multifamily lease. I think another element to it is that we are in turn making an implicit promise to our partners that we will always be around in any economic environment, as we're not saddled with tons and tons of lease exposure. And so that's why we think that the market's heading that direction. And in terms of performance, I think we've answered one of the big questions, which is what does a downside scenario look like? And so having just operated through the kind of worst imaginable environment during the pandemic, we were operating at 2x or more the level of the hotels. And this is because we've been able to drive in longer term stay guests. This is part of the flexibility and duration of leases. Our units work really, really well for longer term stays. And so 81% of our guests during the pandemic actually indicated that they were working remotely out of our units. And again, I mentioned that folks were staying for an average of 21 days. And so working comfortably out of an apartment style setting is very different than that of a hotel room. And so, in fact, I'll provide just a few specific numbers here. In our property in New York, which I mentioned is the #1 hotel in the country, this year, as an example, we are actually outperforming our comp set by 2.2x on a RevPAR basis. So if you take the average of every single day this year, our RevPAR is averaging more than 2.2x that the RevPAR of our comp set. Our comp set includes 2 Thompson hotels, 3 Marriott hotels, and a Hilton hotel. So some very formidable competition. And so, yes, I think that's another big element is understanding the downside protection, which is actually, quite strong.
That's really interesting. And it sounds awesome, of course. But Shaun, I'm really curious to hear your side of things with, this pretty significant agreement that MintHouse proposed to you and your team. What did things look like on your end? Were there any hesitations that you all had?
Yeah, I mean, there certainly were. I mean, I think the biggest with the management agreement was just that it felt a little bit like we were getting into the hospitality business, which isn't something we designed these projects to do, or a business that we had really wanted to be in. So it just felt a little bit like we were going to be operating, a hotel more than we would have liked to. And then just also the short-term rental model was relatively new, initially when we started talking about this, and then, has grown and had some better adoption, I think, since. But, it's just the question of getting us as operators comfortable with it, and then also our investors and stakeholders as well, who are even further removed from operating these. And then finally, it was just, what would capital markets, how would they view the revenue streams? Is it, dollar for dollar? Is it kind of a fallback to the multi revenue streams, or, just how would that work? And are there any issues that could come up there?
Definitely. And Will, what did that look like to you guys when you were having this conversation? How did you guys get ZOM Living over the hump?
Yeah, I think Shaun raised a number of questions that we get all the time. I think one question we get out of the gate every time is, well, what does this mean for the rest of my residents? Is this going to be disruptive to the building and the community that we have? We're now operating 20 plus buildings where we're sharing that facility with traditional tenants, and I think are doing so in a way, and we're kind of expanding in those buildings and moving into additional buildings with our partners. So we're able to significantly minimize any potential downside using technology effectively. I think it starts with the guest. We're driving in a business traveler. So this is the same type of traveler that's been staying in these multifamily buildings since the 90s with the rise of corporate housing companies. Where this is sort of the next evolution of making that model a little bit more flexible and applying some technology. We do run security checks on any guests that aren't coming directly from a corporate through the GDS through our corporate relationships. And then I think importantly on top of that, we're working very hard and invest heavily in turning our presence in the building from a potential negative into an amenity for the rest of the building. And so we actually offer, as an example, a cleaning amenity to the 12-month residents that they can book with just a few clicks from our cleaners at a way below market rate because our folks are coming in on hourly. So suddenly as a guest, you've got this very powerful amenity from a building approved background check cleaner at a very reasonable price.
It's great, and a really, really valuable and exciting proposition and agreement and amenities. All of these things sound amazing to a potential partner and investors. But here at real estate, a lot of the time, what we really care about is numbers and data and ROI. Will, what does an ROI look like with a partnership with MintHouse?
Yes, so I think the exciting part of today is we're going to show actual operating data from our operation at Music Met with ZOM and Shaun, and just show you exactly what it looks like. So we moved into this building in January of this year. So the pandemic, of course, still raging at that point in time. And here's a look at what we're able to do in terms of occupancy. So in our very first month of operation, we started with a 40% occupancy, and by month 2, we were able to drive that all the way up to an 87% occupancy, 92% in our third month of operation. And we've continued that and actually continued to drive rate as we have ramped up. We generally consider a building fully ramped between 3 and 5 months, depending on a few factors like seasonality and unit count. But what's interesting is if we go to the next slide, here's what we have. We have graphed the actual cash payments to Shaun and ZOM relative to the NOI, so the net cash payments that they're receiving from a traditional multifamily resident in a exact copy of our unit on a different floor. And so actually in the very first month of operation, we're able to earn $2,000 more than the comparable 12-month tenant unit was earning, and that has only gone up from there. In June, we're more than double the NOI that they're earning through traditional multifamily means. And so, this is something that is, pretty consistent across the portfolio. Some markets are stronger than others, but generally speaking, this is the type of performance that we can deliver for our partners.
That's really, really cool. So Will, you have me sold. I'm excited to enter a management agreement with MintHouse. What does a timeline look like to get things started?
Yeah, so a lot of it depends on the situation of the building. So in this case, this was in lease up. And so from the time that we sign the contract, we can generally be in the building operating in less than 45 days. Now, we have ground up development projects. We have some acquisitions that some of our capital partners are executing. And so a lot of it depends on the situation. But from LOI to full contract, we can generally get through in a matter of weeks and then be operating in less than 40 days, 45 days after that.
Wow, Shaun, did that happen?
Yeah, generally. I mean, we had with Muse, there were a lot of cooks in the kitchen on our side, if you will. So it was an arduous process to say the least. But as Will said, I mean, very quick, expeditious. I think one of the things that has worked really well for us and why we kind of have the relationship we have is it's just very, to the point. These are the specifics of the project and the deal. And then Will and team are able to craft kind of the agreement, to flex to whatever the flavor of the day may be for our needs. So it's been really, really good and really efficient. And, as I think we alluded to before, each of these projects of ours are really specific. They're really detailed, and there are nuances from the project level, the investor level that need to be worked through. And, Will and his team are really good about, listening to those and addressing those concerns and then helping craft the agreement accordingly.
That's great. Really, really great to hear. So we've come to the end of our discussion. Will and Shaun, any final thoughts before we send our audience off?
Yeah, I'll just sort of wrap this up. I think, just to understand how this is possible. So how is it possible that MintHouse can step in and earn more than 2 times the NOI in a building that was, designed for really another use? I think it comes down to 2 things that have converged at the same time. One is this rapid shift in consumer preference towards Airbnb style, apartment style accommodations that have taken place over the last 10 years, coupled with a really small amount of supply that is professionally run and operated. So that is basically the only supply that's available to these corporations that have tons of employees that are looking for Airbnbs, but aren't allowed to stay at them for work because of obvious security and safety reasons. So that supply-demand mismatch, coupled with the fact that smartphone penetration didn't hit a level that would have allowed our operation to leverage technology in the way we do, except for in the last 10 years. And so it's and that allows us to run these operations very efficiently with a high touch, high guest experience offering, but keeps costs way down. And so we think that flex multifamily as a result is an inevitable asset class that's in the process of being created and will ultimately be a multi-billion-dollar category over just the next several years. And that flex multifamily will go just the same way as student housing, which was not an institutional grade asset class 20 years ago, and today is an asset class that most major asset managers own.
That's great. Well, thank you both for your time, Will and Shaun. I know our attendees are giving you a huge round of applause right now. We can't hear them, but it's going on. To our attendees, thank you so much for joining as well. Feel free to make your way to your next session, your next meeting, and don't forget to check out our virtual booths. Thank you all again, and we'll see you soon.